everyone, and welcome. So, you want to get into mutual funds, but it feels like trying to navigate a huge, confusing city, right? Well, what if I told you there's a map, and we're going to use it to crack this code together? Let's do this. Yeah, look at that number. Over 2,000 mutual funds just in India. It's totally normal to feel a little lost. In fact, it's a classic case of analysis paralysis, isn't it? So many choices, you don't even know where to begin. But here's the thing, and it's a real game changer. You absolutely do not need to know the name of every single fund out there. That is not the goal. You just need a map. And the best part? Our market regulator, SEBI, has already drawn one up for us. How cool is that? All right, so here's our game plan. We'll start with the roadmap itself. Then we'll dive into equity schemes for growth, debt schemes for stability, see what happens when you mix them, and finally, figure out how to choose your destination. Okay, so let's talk about this roadmap. SEBI, that's the Securities and Exchange Board of India, basically looked at this whole messy situation and said, let's bring some order to this chaos. They created a system that standardizes all funds into a few main categories. It makes everything so much more transparent and, actually comparable. It's like they've organized a giant messy library by genre, so you can finally find the exact book you're looking for. All right, first stop on our map, equity schemes. If you're chasing growth, this is your territory. Plain and simple, these are the funds that invest your money into company stocks, or equities, with the big goal of watching that money grow over the long term. So, within equity, the main way we slice things up is by company size. Think of it like this. Large cap funds, they invest in the big guys, the top 100 blue chip companies in India. They're stable, like giant oak trees. Then you've got mid cap funds. These are the rising stars, companies ranked 101 to 250. More room to grow, for sure, but also a bit more shaky. And finally, small cap funds. These are the acorns with massive potential, but they also come with the highest risk. And you can see here, SEBI makes sure these funds actually stick to their labels by mandating how much they have to invest in each category. Okay, so what if you don't want to pick just one? What if you want a mix of everything? Well, you've got two main options. On one hand, you have the multi-cap fund. Think of this one as the rule follower. It's required by SEBI to invest at least 25% in large caps, 25% in mid caps, and 25% in small caps. It's disciplined, built-in diversification. On the other hand, you have the FlexiCap fund, the rule breaker. Here, the fund manager has total freedom. They can go 70% in large caps one month and then shift to 50% in small caps the next, all based on their view of the market. It's all about tactical flexibility. Now, besides the main highways, there are a few specialized routes on our map. You've got sectoral or thematic funds. These are for when you want to make a really concentrated bet on one single industry, say IT or banking. It's definitely high-risk, high-reward stuff. And then there's ELSS. This is a popular one because it's a two-for-one deal. You get the growth potential of an equity fund plus tax benefits. The only catch? There's a 3-year lock-in, so your money's tied up for that period. Okay, let's pull a U-turn and head to a totally different part of our map. We've talked about chasing growth with equities. Now let's talk about seeking stability with debt schemes. This is a completely different mindset. If equity is like buying a piece of a company, debt is like being the bank and lending money to them. The goal here isn't explosive growth, it's steady, regular income. So what is a debt fund? Well, it's pretty straightforward. The fund takes money from a bunch of investors, like you and me, and lends it out to big entities, like corporations or even the government. In exchange for that loan, they pay interest. So the fund's goal is to collect that interest and pass it on to you. It's generally a much calmer ride than the stock market. The single most important concept to grasp with debt funds is duration. It's basically just a fancy word for how long the loan is for. It's a spectrum of risk. At one end, you have the ultra-safe overnight fund. The loan is literally for just one day. A tiny step up is a liquid fund, where the loans mature in under 91 days. As you move along the timeline to ultra-short and then short-duration funds, you're lending for longer. And in return for that, you get a little more potential return, but also a tiny bit more risk. Okay, so we know how long is important. The other key question is, who are we lending to? A corporate bond fund typically sticks to high-quality, very reliable companies. Think AA+ rated and above. On the flip side, a credit risk fund intentionally lends to lower-rated companies. Why? Well, it's a bigger risk, so you get a higher potential interest rate in return. And then you have gilt funds. These only lend to one borrower, the government. And since the government is considered the safest borrower around, these are pretty much the safest debt funds you can get. But hey,
What if you're feeling a bit indecisive? You want some of that growth from equities, but you also want the stability of debt. Well, you don't have to choose. That's exactly why hybrid schemes exist. They are literally the best of both worlds, mixing stocks and bonds together in one single fund. Let's look at the first type, the conservative hybrid fund. The name says it all, right? Check out the chart. It's dominated by debt, anywhere from 75 to 90%. That's the stability part. Then there's just a little splash of equity, maybe 10 to 25%, just to give it a little boost. This is perfect for someone who's really cautious and puts safety first. And now, let's completely flip that recipe on its head. This is the aggressive hybrid fund. As you can see, the main ingredient here is equity. We're talking 65 to 80%. The focus is all on growth. That smaller chunk of debt, that's there to act like a shock absorber, just to cushion the ride a little bit when the stock market gets bumpy. And for those of you who are more of a strategist, or maybe just want to put things on autopilot, there's a really interesting option, dynamic asset allocation funds. These are smart funds. They automatically shift the money between stocks and bonds based on what the market is doing. So when stocks are expensive, they might sell some and buy more bonds, and vice versa. The fund manager does all the heavy lifting for you. All right, we are now entering the final sections of our map. These last few categories are less about general strategy and more about very specific goals. Think of them as custom destinations. First, you have solution-oriented schemes. The name gives it away, right? These are built with a single purpose in mind, like saving for retirement or a child's education. They often have a lock-in period to keep you on track. Next up, index funds and ETFs. These are the no-frills, low-cost options. Their only job is to copy a market index, like the Nifty 50. As closely as possible, simple and effective. And finally, a quirky one, fund of funds. It's a bit meta, as you can see. It's a mutual fund that invests in other mutual funds. You know, at the end of the day, this whole map, it's not about finding the single best fund in the universe. That doesn't exist. It's about giving you the power. Because when you understand these categories, suddenly you have clarity, you have confidence, and most importantly, you have control over your own financial journey. So let's bring it all together. This right here is your personal roadmap, your starting point. Just ask yourself, what is my main goal? If the answer is growth, then your first stop is equity schemes. If it's stability and income, head over to debt schemes. Looking for a healthy balance? Hybrid schemes are where you should start. And if you have a very specific goal or just want something cheap and simple, well, you now know exactly where to look. So there you have it. We've gone from a confusing, massive city to a clear, well-laid out map. Sebi drew the map, and now you know how to read every single landmark and highway. The power is officially in your hands. So the only question left to ask is, what's your next move?